Top of the afternoon as it is. Yeah, so my coffee's actually cold because it is the afternoon and I have had probably enough. I thought today, since the pharma portfolio is doing so good and it was a pretty clean criteria, then I'd do another one. But before we get into that, quick disclaimer, reminder to everybody. This is for educational and entertainment purposes only. Take another quick look at the mountains above Kenai Lake. And with that, let's get into it. Okay, top of the afternoon, it's June 30th. The month has ended. I'm Captain Ron, this is Financial JQP, and today what we're going to do is look at a new portfolio. And just to remind everybody what the standard portfolio construction process is, or at least the one I use. When I come up with a new portfolio, I come up with an idea, a hypothesis. I get some idea, I do some research, I see something in the news, somebody feeds me an idea, and then from that idea, we go figure out if we want stocks, ETFs, mutual funds, we go find the candidates, we use the online tools to refine that, and then when we're done, we set the rules for managing that into the future. We go and purchase the portfolio, either all at once or dollar cost average going into the future, or set it up for standard savings per month. Ideally, 15% out of your savings goes into a savings portfolio of some sort. All right, so quick look at the standings today. The pharma is what we are noticing here. So this is our observation, is the pharma has well overtaken the benchmark. It is doing well. It's got a pretty clean criteria, and we'll look at that in a second. The LH is doing poorly. The hantavirus is doing even more poorly, and the rest are all chugging along uneventfully. What was the pharma portfolio? So this was the original LH. These guys fell out because they were a little bit different, but very interesting. So this is healthcare only with a current ratio of greater than 1.5, and this is a measure of liquidity. A quick ratio of greater than 1.5, which is also another measure of liquidity. Return on assets, this company needs to be making money. It's important to be making money. If you're making money, you're going to survive. Ideally, you do well. It has to have low debt. Debt to equity less than 1 is typically, it's shareholder financed rather than bank financed, and we like that better. It tends to produce better results. And then we want a stock that's climbing. The 200-day simple moving average is going up. And then in the case of the pharma, we limited the search. We've got it down to 10 or 12 by just picking the ones with higher gross margin. Well, the tool we're going to use for searching on this one is Finviz, which is a free tool, finviz.com/screener online. It's got 11,000 equities. We're going to call this the good one. These are profitable companies with low debt and some upward momentum of the share price. These are stocks going up, they have low debt, and they're profitable. It's a good, clean criteria. For this, we're going to search for non-pharma initially. We're going to look to cover all the sectors. We're going to look for 20 or so stocks, 5 per sector maybe. We're going to use the 3-year efficient frontier to set expectations, and then we'll use the criteria. We'll make it more restrictive to get it down to the 20 or 30 stocks that we're looking for. So here is the search URL that I used for Finviz. Finviz looks like this. It's got our search criteria. In this case, I've got 7 things, 4 plus 3, different windows. And then these healthcare ones, we're going to get rid of those. We're going to pull all the healthcare ones out of it for now. And then I loaded this into the efficient frontier to take a look at it, and Portfolio Visualizer kicked out 5 of them. I know some of these have got, SanDisk has got lots of data, so I don't know what the deal is with that one. Portfolio Visualizer kicked those 5 out. So we'll use the rest of them just to give a feel for what this thing does. If we look at this in terms of the efficient frontier, our portfolio is here. It is the equal weighted of all of these stocks that we have, not including the 5. It has a totally ridiculous historical 3-year return, which we will not assume that goes into the future, but this is a good measure of standard deviation. So what we're going to use to set expectations, we'll go ahead and use this standard deviation of 22%. Let's put a guesstimate way down at 18%, and hopefully this is conservative, but we'll find out. This puts the 2 sigma down at minus 27, so this is definitely a high risk, high reward, aggressive portfolio. And then at the request of one of you guys, I'm going to add the XLE.XLK as a benchmark to this. So this is a 50-50 tech and energy ETFs. It's actually a really good portfolio. So this is another good benchmark portfolio, or just portfolio altogether. This is a portfolio that you typically can't trade in your 401k, but you can in your brokerage accounts. And if we take a quick peek at the XLE.XLK portfolio, which will start both of these at 10,000 hypothetical, but this one produces actually similar returns to the portfolio we just produced. Standard deviation is almost identical and expected returns 23%. If we pull a much larger time, this comes down to that 14, 15, 16%. So again, I would expect the future of this standard deviation is probably accurate, and I would expect this probably to beat the S&P 500. So this is going to be a new benchmark. I loaded the initial stocks into Morningstar, and this is where we can see diversification, get a feel for the stocks that we've chosen based on our criteria. How diversified is it? And we can see that this is all U.S. stocks. To be diversified, we like 15% international, so not diversified internationally. This did produce some smaller companies, which is okay. This is just a small to mid-cap fund. When we look at the sector diversification, we can see it missed several sectors. It's missing basic materials, it's missing real estate, it's missing healthcare, of course, because we ruled healthcare out of it going in, and then utilities. So what I'm going to do is I'm going to loosen up on the criteria a little bit, and then let's see if we can't fill in some of those sectors. And also, the one stock VALU ran it through the Fidelity basket portfolio. It said this guy was illiquid and ineligible, so we'll just pull that one out, keep the illiquid ones out. In Finviz, I went back into Finviz and I loosened up the criteria, and then I also said in the country, give me the non-US funds. So this is going to find a completely new list because all of those were US. And then I reduced the current ratio, quick ratio, return on assets, debt to equity a little bit, and I reduced the simple moving averages to be just above, not 10% above. And I came up with a list of 30-40 stocks, and out of these I grabbed the healthcare ones and the basic material ones, and there wasn't any real estate or one of the other sectors that didn't show up, so we'll just add these two sectors back in. And then I did notice this AUPH is duplicated in our pharma portfolio. Keep an eye on that 2% rule, no more than 2% in any one stock. Let's not duplicate this in this portfolio, so we're going to leave AUPH out of this. This is our final list of stocks. We've got our fictitious $10,000 we're putting in this, which is about $430 a piece or so stock. We do this equal weighted as our portfolio building technique. And then we run the new one through Morningstar. We can see we're at 13% foreign stocks. It's pretty close to 15. Morningstar says this is aggressive, hold it for more than 10 years, which is what we've been saying too. Stock style, as we know, is a small cap stock. Morningstar reminds us not to ignore the large cap stocks. And then if we look at the stock sector, we have indeed added some basic material and healthcare. And Morningstar points out you're low on financial services and industrials, which is okay. I think we have a pretty diversified portfolio. The rules to manage this portfolio. So we're going to monitor it and adjust it as needed. This is a buy and hold long-term portfolio, so it's not intended to be traded. If we see any stocks shoot through the roof, we might sell some of that stock and take some of that money to reinvest. This is not a classic rebalance. There's no bonds here, so it's not like we're going to rebalance the bonds and equity. But what I want to do on this one is to rerun the search annually. So I can just take that URL, run it in, and see what new things show up and take a look at them. And also look back on low performers and maybe pull the low performers out and add some of the new ones in as new candidates. There will be a few dividends, not very much, super small. We'll just let this cash accumulate and we'll reinvest it at the end of the year. And then any of them that drop considerably, go look at them, figure out why they're dropping, compare them to the sector they're in. If the sector's going up and they're dropping and they drop 30%, then maybe we just sell them and retain the cash for the annual rerun. To recap what we just did, we came up with a hypothesis. The pharma portfolio is a good one. We used Finviz to filter the stocks. We iterated on Morningstar a couple times to adjust the diversification. And then we jotted down the rules for managing this portfolio. Just in case it goes crazy in the future, we can go look at those, refer to those, and run those appropriately. Then we used the efficient frontier to set some expectations, although the returns were crazy high. We don't expect those, but we do expect this thing to be fairly volatile. And with that, a quick look at the mountains again and bidding everybody adieu. Top of the afternoon at this end of June. Those are the mountains back in April. A bit of snow on them.